lives at my feet now, so if I ever turn off if I mute me, it's usually because she's barking.
She has to leave the room when we go in executive session.
Well, she's a border collie, so she could be smart enough to know what people are saying. She knows what I'm saying, I'll tell you.
All right, let's go on the record then and start the meeting.
You're live.
So good morning, everyone. I've noted that we have a quorum present, so we can move forward with the meeting of the Police and Fire Retirement Plan Commission. Nikki, can you confirm that the meeting was properly noticed?
Yes, I was.
Okay, so any old business. I have two items. First, we provide an annual report to the City Council, I believe, about what transpired in the past year, including attendance and a general description of what the commission attended to. I believe it was circulated to everyone. If not, Nikki can provide you with a copy on request. And then each of us should have completed a questionnaire for the city disclosing any conflicts of interest or whether any family members work for the city. And those, I believe, should already have been filed. So if you're late, please take care of that. With that, are there any other items of old business anyone wishes to raise?
Joe, on that last one, I see Ashley. I assume that my filings as alderman suffice, but is there something additional that I need to do? Because I haven't done anything.
I'll allow Ashley to address that. I'm not aware of anything, but
Okay.
We're talking about the 2020 financial disclosure forms.
yes.
I mean, Karen in my office will let you know if you need anything else because she's the liaison for ethics. But if you filed them, they'll review them, and then if they're missing anything, they will let you know.
Oh, they do.
Yes, they will. So no worries on that.
All right. Thank
Just
you.
embarrassing. It's embarrassing when they call and they say, "Is that all?" With no other items of old business being brought up, let's go to a review of the overall markets and the performance of the plan, which is going to be in general session. We'll talk about particular managers in executive sessions. So, Ian, I would ask you to sort of observe that general rule in making a presentation.
Sure. So what I did is I put together a snapshot of where the markets were as of close of business yesterday. And then I also, in the next page, reviews where the markets were as of December 31, 2020. And we've gotten off to a strong start. And the strong start is largely attributable to everything that's happened in February and the last week or so. January was a flat to negative month, but February has been fabulous. And so if you look up at the top of the page and you look at year to date, the S&P 500 through yesterday was up about 4.28%. But if you look just to the left of that, MTD is month to date. So that is just the partial month of February. And you can see the S&P is up 5.3% in the month of February. We've seen a rotation from large to the smaller cap part of the market. And so you can see mid cap year to date is up roughly 9.5. And small cap, represented by the Russell 2000, is up 16.5% year to date, which, and look at that number to the right of it. For the 1 year trailing as of February 9th, the Russell 2000 is up 40.6%. So really significant contributions to return coming from the smaller companies. And you know, for a long time, large cap was the place to be, and large cap has led over 10 years. But basically there was is a general feeling that there's better value. You can buy $1 of earnings in general cheaper in the small and mid cap part of the market versus large. We saw a rotation at the end of 2020 from growth to value, and that rotation, the sort of catalyst for that was the news when Pfizer announced the vaccine being released, and that was sort of the trigger point for what many believed was going to be the recovering economy environment. And in that recovering economy environment, a lot of the sectors of the market that had trailed started to do better. And so when you look at sectors like energy was the worst performing sector in total for 2020. But then when the Pfizer news was released, energy stocks started to do better. And the reason is that investors believed that with a vaccine and with a recovering economy, then people would start to travel more, and the parts of the market like energy, which had not been embraced during lockdowns and the height of the COVID impact in 2020 would start to contribute more. And that's what happened. So like energy, when you can see, just like in 2021, year to date, energy is the leader, up 15.8%, as detailed below. But still, when you look at energy going back 10 years, it still has a negative return, down about 2%. But that is what has helped many of the value-oriented managers late in 2020 and leading into 2021. We've also seen better returns coming from the international markets, and particularly the emerging markets. You can see year to date, the international emerging market index was up about 9.25%, which is, for roughly a month and a half, is a very strong return. And then the developed markets, represented by MSCI EAFE, was up about 3%. In the fixed income world, for the year-to-date period, high-quality investment-grade bonds, represented by the Barclays Aggregate Index, was down 1%, and that's because of a general rise in interest rates. So when rates go up, bond values go down. And then the high-yield part of the market, which was hurt the most in last year in February and March, has still continued to recover, and you can see a 1.25% return year to date through close of business yesterday. I continue to show down at the bottom the performance of what we refer to as the FANG stocks. So that's Facebook, Amazon, Netflix, Microsoft, Apple, and Alphabet, which is Google. It's pretty amazing. The FANG stocks didn't contribute as much late in 2020, but as of recent, some of them have contributed significantly. And one in particular is Alphabet, which is a parent company of Google. And you can see year to date, Alphabet is up 18.9% through close of business yesterday. Also very strong performance coming from Microsoft, which was up 9.6% as of yesterday. Any questions on the review through yesterday?
So Ian, I continue to hear all this chatter that the market, the stock market is way overpriced, and that there's going to be a pending 40% correction and a big drop, and get out of stocks now. What do you think about all? I'm sure you hear that too. What do you think about all of that talk?
Well, I as well believe that the market is a little extended relative to fundamentals. And I believe that at some point we are due for a pullback, and a pullback being, some sort of correction. But that to me is not necessarily bad. I think when you look at other periods of time where the market gets ahead of itself and you have a pullback of 5-10%, it sort of brings reasonableness back to the market and levels the playing field a little bit. And that's part and parcel of investing in equities. We can't, we just can't continue to grow in the valuation of the equity market at the pace that we have. If you look at the top of the page and you look at the returns over the last 5 years, the S&P 500 has grown at 18.4% per year. Mid-cap stocks are up 16.9%, and small company stocks are up over 20% per year over the last 5 years. And relative to on a 10-year basis, we're looking at roughly almost 14%, 12%, and 12.5%, over 10 years. And that's relative to a historic average for equities a little bit better than 10% back to 1926. So, the market has been driven, the market was driven by fundamentals back in February and March, where there was a lot of concern about the economy and the impact of the virus on individuals and on businesses. But then, we've gone over during our meetings the various reasons why the market went higher, and it wasn't because of fundamentals, but it was, more so technicals. And we're not complaining with the strong performance of the equity market, but at some point fundamentals will matter, and you have to look at how much these companies are selling at relative to the earnings that they generate. And I think that's the concern. And so the hard part about this is, like, here you just heard me say, like, it wouldn't be unreasonable to assume market pullback or a correction. And some people say, well, Ian, if you feel that way, then maybe we should get out of the market. But that's, if we could pick the date or the inflection point, we would do it all day long and make a ton of money. But it's really hard to do that. So we sort of have to maintain our posture. And we've also seen that, and I'll show it to you in just a minute, is that, we have these 5 and 10 and 15% corrections, and they happen over a very short period of time. And then at some point the market turns around and we gain back what we lost. And that's not, a recent phenomena, but that goes back for many, many decades. The hard part is picking the inflection points of when the market goes up and when the market goes down. So a long-winded answer or non-answer to your question, David. But what do you have any other observations?
Well, I mean, if we did decide this was an inflection point, and decide to move our money out of stocks, I mean, where do you move them? Clearly, interest rates have nowhere to go but up. So the fixed income isn't a great place, and interest rates are so low that a cash investment right now doesn't really help us a lot, other than provide safety. So, where else would you invest if you decide right now to pull out of the stock market?
I think rather than answer that at this point, Ian, let's suspend this conversation, because that's going to go really into the meat of how should we be managing the portfolio, which we'll do in executive session. And so before we get there, we have some housekeeping items to take care of. The minutes of the last meeting were circulated. Those are the minutes of December 3rd, 2020. Were there any comments, any suggested changes of those minutes?
Move approval of the minutes.
Second,
Those in, is there anyone opposed?
No.
And those in favor? And sort of wave their hand at Nikki and let's
Aye.
record that we have acceptance
Aye.
of the minutes.
Aye. This is Jody, aye.
David, I will address some of that when we go through the various parts of the portfolio and we talk about, where we are today and looking forward.
So
Thank you.
with that, I'm going to call the
What-
meeting into
Excuse me,
executive.
Joe,
Yeah.
was there a second page? I thought you alluded to a second page of this, Ian.
Yeah, the second page is detailed here, and this shows the returns for the equity market indices and fixed income as of December 31. And you can see, looking up at the top of the page under the 1-year column, we ended the year with domestic equities up in the range of 17 to 20%. And growth was the clear winner. You can see the Russell 1000 Growth Index was up over 38%, where the value index, and that's the index which is used for a manager like Edgar Lomax, only returned 2.8%. And international, you can see developed international represented by EFI was up 7.8, and the emerging markets were up 18.3. So a pretty phenomenal year when you think of, how things felt back in February and March, and none of us would have assumed, we would be finishing the year with returns similar to, 2019. And then, a strong start to the year as I just showed in 2021. On the fixed income side, the returns, your plan has an actuarial interest rate assumption of, I think, 7.45%. And bonds by themselves, returned 7.5% and better last year. And you can see the US aggregate index was up 7.5%. Corporate investment grade bonds were up almost 10%. And high yield bonds were up better than 7%, but that doesn't show the volatility in the market. Like high yield bonds were down 25% in the February, March period, and then they came back, they were up 35% for the balance of the year. So pretty phenomenal results. And this particular chart shows what I was talking about in terms of the losses of 5% and greater, which are highlighted in pink. And then the recovery is shown from the trough back to regaining the losses. And this is from the peak of the market in October of 2007 to the current environment. And I'll try to highlight an area, this area up here in the upper right-hand corner, from the trough until the end of 2020, the S&P 500 returned 70.18%, and the market bottom was on March 23rd. So just a phenomenal. Now, we also lost 34%, and we lost that that's right down here. We lost 34% in the S&P 500 over the course of 23 days. And it took 97 days to get back to water level in terms of where we regained all of those losses. But then you look at these periods up here, these numbers up to the right are any period where the market lost more than 5%. So there is 4 subsequent periods from February to the end of the year where the market corrected by more than 5%, only to then be regained in the following days after that. And you can see there was a 5% loss that took 4 days, and it took 1 day to gain it back. And then a 6.8% loss over 14 days, and it took 15 days to gain it back. And so you sort of have to strap in, but then we'll talk about other areas where returns could potentially be gathered.
Ian, do we have these pages? I didn't see them in my attachments.
I sent these out, I think, on like late last week.
Yeah, I had a whole bunch of stuff from the 4th of February, but I don't remember pulling this up.
Yeah, so I sent them out, but I can, and then this morning I created one master document so I wouldn't have to be flipping back and forth. And I can send out this master document after the meeting.
Thank you. I would appreciate that.
Joe, those are my comments on the market.
So with that, I'm going to call the meeting into executive session so that we can discuss the particular performance of our investment managers and any strategy changes we wish to make.